Hi everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. This time we're diving into Range Resources' proxy statement, which is a bit like getting a peek at their homework before the big test. I'm kidding, it's a very serious report. Get ready for some board member shuffling, executive pay insights, and my take on where this natural gas company is headed. Range Resources is inviting stockholders to their annual meeting on May 14, 2025. They want you to vote on who sits on the board, how they pay their executives, and which accounting firm gets to check their books. It's all pretty standard stuff, but the details are what matter. First off, let's talk about the board. James Funk is retiring, making room for Christian Kendall, a former CEO from the energy sector. The company is all about having the right mix of skills and experience on the board, and that seems like a good thing for the company. They've been refreshing the board, bringing in new independent directors. It's not just about who's in charge, but how they're paid. Stockholders get an advisory vote on executive compensation, which means you get to weigh in on whether you think the top dogs are getting paid fairly. Last year, 98% of votes supported their pay, so it seems like stockholders are generally happy. But let's see what the compensation program actually looks like. Range is emphasizing a pay-for-performance model, meaning a lot of the executives' pay is tied to how well the company does. It sounds good in theory, but we'll have to check if what actually happened is in line with what the stockholders are expecting. Here's the breakdown of what they look for, things like experience, job responsibilities, and how their peers are getting paid. The bonus part gets interesting. It depends on hitting targets for cash flow, keeping costs down, and returns on investment. There are also bonus components that incentivizes the executives to act safely and responsibility in the environmental end of the business. In 2024, their production was 68% natural gas, 30% NGLs, and 2% oil, and they hit a 100% drilling success rate, but did that translate to success at the executive level? The bonus targets are intended to measure improvements across financial, operational, and strategic execution. Cash unit costs had 137% payout, meaning costs were exceptionally low. Return on average capital employed, however, was at 96%, a near miss. But all that translated to excellent ratings on the bonus. The incentives encourage management to focus on what is in their control, which seems like a good setup. Diving into the executive pay, we have Dennis Dignor, the CEO, getting $123.6 million in bonus pay. Mark Scutchy, the CFO, is not far behind with $819,000. That is all in addition to things like stock awards and other compensation that goes into their almost $8 million package. Getting the right people at the table is key. It looks like the board is composed of independent and experienced members, with qualifications ranging from finance to engineering and environmental expertise. There's a good mix of backgrounds, which is always good to have, especially in a business as volatile as this. The non-employee directors are getting paid roughly $300,000 a year, mostly in stock awards, with a little extra for the chairman and committee chairs. One thing to keep in mind is that directors are expected to own a good chunk of Range stock. Looking at how much stock the big people own, we're seeing the CEO, Dennis Dignor, controls a good amount of stock with almost 800,000 shares, and a lot of the directors have respectable holdings. This means that their interests are mostly aligned. Looking at major stockholders that aren't on the board gives us some additional context about the company. Big firms like T. Rowe Price, FMR LLC, Vanguard, and BlackRock hold significant chunks of Range Resources. The presence of these major institutional investors says that it's a pretty solid company with institutional trust. Ernst & Young LLE is back as the independent auditor. They're getting paid a few million for the audit and a bit more for tax services. Now, the part everyone cares about, pay versus performance. It's always a fun one. In 2024, the CEO made almost $8 million, and the average NEO took home over $2 million. But were they worth it? It really depends on who you ask. Net income seems to follow TSR in a way that one might expect, so there is no surprises. But it's worth pointing out that the CEO made 39 times the median salary for the company. Now let's zoom out and look at the big picture for Range Resources. They're betting big on natural gas, particularly in the Appalachian region. It positions them well for domestic use in the lower carbon world of the future. It's a solid strategy because they have some of the lowest emissions to production ratio. Their peer group of other energy producers is also worth following because their value is tied to relative performance between the actors in the sector. So what's my final take? Range Resources seems to be navigating a tricky market reasonably well. Costs are down, they're making money, and the executives are getting paid. You might like that or dislike that. What I don't like is the large executive compensation compared to average workers. But you can't deny the incentives seem to be doing what they're designed to do. Lower risk, sustainable production, and growth for range. That's all for today. If you enjoyed the deep dive, smash that like button, drop a comment, and subscribe for more corporate decoding. See you next time.